Hi everyone! In this video we're talking about accounting for transactions in a merchandising operation. We are under the perpetual inventory system, and in this video we're focusing on sales transactions. And I'm of course your instructor Brandy. This is going to act as a continuation of our last video, and in our last video we were talking about the purchases of inventory. And in this video here today we're going to be talking about once we already have the inventory purchased in our warehouse, how do we account for the transactions when we sell that inventory? So in this video, we are focusing on selling the inventory. In the last video, we talked about when we were buying inventory, and we had come up with these transactions here in this T account. The perpetual system means that we always have to keep track of our inventory account. So anytime we do a transaction with buying or selling inventory, we're going to be updating that inventory account. Remember, the inventory account is an asset account, and it would be a current asset on the balance sheet. So now let's jump into making sales transactions. What happens when we actually sell the inventory to customers? So let's look at an example. In this example, Parker's Shoe Store sells shoes to customers for $1,000 cash on May 15th. The shoes had cost Parker's Shoe Store $300. Okay, so there are two things happening in this transaction. First, we're selling shoes to customers and collecting $1,000 cash. And the second thing is that the cost of the shoes to us was $300. This is going to be two different transactions under the perpetual method. The first transaction is to record your sale and collect the cash. Debit cash for $1,000 and credit sales revenue for the same amount. The second journal entry will be on the same date. And this journal entry is going to be removing the inventory from our warehouse or from our store and bringing it as an expense to the income statement. And the expense account that we use is an account called cost of goods sold. Once we sell the inventory, it no longer has a future benefit to us because it doesn't belong to us anymore. It belongs to our customer. Therefore, it's no longer an asset, and we need to move it to the income statement as an expense. We're going to debit this for the cost of the inventory, which if you look up in the description, the cost to Parker's Shoe Store is what we bought this for, $300. And we are taking it out of our inventory account. So our transaction, debit cost of goods sold and credit inventory for $300. Now let's go back to our T account and update it. Let's try another example. In this example, Parker's Shoe Store sells $1,500 of shoes to a customer with terms 1/15 and 30 on May 17th. The shoes cost Parker's Shoe Store $450. Now remember from our previous video on purchasing inventory that these are discount terms. So this means that the customer gets 1% off if they pay within 15 days, but the full amount is due within 30 days. At the time of making the sale, it makes no difference to us about the discount. When we check if the customer receives the discount is when they actually pay us. So the journal entries for these transactions on May 17th. So remember that when you sell something under the perpetual inventory system, you have to make two journal entries. The first journal entry is to record how you're receiving payment. So in this case, we're using our accounts receivable. They're going to pay us later. And we're crediting our sales revenue. And the second journal entry is to record the cost of goods sold and remove the inventory from our books for that sale. So now let's go update our inventory T account. So going back to this May 17th example, let's talk about what happens when the customer actually pays the bill. If the customer paid outside the discount period, so if more than 15 days had passed from when we received our payment, then our transaction would just be simply debit cash, credit accounts receivable for the full $1,500. However, if they pay us within the 15 days, we have to honor that discount and they can pay us less money. They can pay us 1% less. So let's look at that example. The customer that bought shoes on account on May 17th sends us a check on May 23rd for the full amount owed. So remember back to May 17th, the customer had purchased $1,500 worth of shoes and the discount terms were 1/15 and 30, which meant they get a 1% discount if they paid within 15 days. They're paying on May 23rd, and that's less than 15 days since May 17th, so they're entitled to the discount. Remember that our accounts receivable balance was at $1,500, so the first thing we're going to want to do is clear that out. That's going to be our credit. The next account we're going to use is an account called sales discounts. And that is exactly what it sounds like. We use this account for when we grant discounts to our customers or to our clients. Our calculation for our discount is going to be 1% times $1,500, so $15. The last account is the cash that we're receiving from our customer, and that's going to be the difference between the accounts receivable amount and the sales discount that we're granting. So the cash we're receiving from our customer is $1,485. So continuing on with our example, a customer returned shoes that they purchased for $200, and the shoes had a cost of $50. And that cost refers to when we originally bought them from our supplier. The return took place on May 25th. So when we receive shoes back from a customer, we actually put those shoes back into our warehouse or back into our sales floor. So two journal entries are going to take place. The first journal entry is to record that we're receiving the sale back, and we owe the customer money or we'll give them cash right away. So we're going to say debit to sales returns and allowances and credit to accounts payable or cash if we're giving them money right away for $200. The second journal entry is to record us actually receiving the inventory back into our warehouse. So now we have that inventory that we can resell if we choose to. So debit to inventory and credit to cost of goods sold for $50. Note that we're updating this inventory account, so we should also update our T account. So let's continue on with our example. We're granting a sales allowance to a customer who found some damage on merchandise that we sent out. The allowance was given on May 29th for $25. And remember that this allowance word means that the customer is still keeping the merchandise, they're keeping the shoes, but we're just giving them a little bit of a discount or money back in return for the damage, but they're still going to keep those shoes. So we're not receiving the inventory back into our warehouse. We just have one journal entry. Debit to sales returns and allowances for $25 and credit to accounts payable or cash for $25. Note that we don't have to update our inventory because we're not receiving anything back. There's just one journal entry here. So remember, in order to calculate my balance on my T account, I'm going to take all of my debits and minus all of my credits. So the balance is $2,260. That inventory balance goes to the balance sheet as a current asset. So now that you've watched this video, you should now be able to account for sales, sales discounts, sales returns and allowances under the perpetual inventory method. Thanks for watching, everyone. The next video is going to take you through how to do financial statements under the perpetual inventory method.